Great. So welcome everyone to our first Exploring Post-Growth Finance event. My name is Anastasia. I'm from Degrowth Switzerland, and we're super excited to kick off this conversation with you all today. There's been a lot of interest in the topic, and we have some great speakers. So I think it's going to be a super fun afternoon. I'll just share some introductory information to get started. I think everyone can hopefully see my screen. So first off, speakers, we have Melanie Rieback with us, CEO and co-founder of Nonprofit Ventures, a startup accelerator for not-for-profit enterprises based in the Netherlands, but working globally, and CEO and co-founder of Radically Open Security, a not-for-profit cybersecurity company. We also have Vibeka Mair, journalist at ESG Investor, who has been working on sustainable finance topics and ESG investing for many years, and recently did a piece on degrowth ideas getting into the banking and investing sector. Super happy to have her with us as well. And Louison Cahen Fourreau of the Roskilde University in Denmark, assistant professor in economics. Louison is an environmental economist looking at macroeconomics and socio-ecological transitions, how we get there basically at the macroeconomic level. So we're super happy to welcome all of our speakers. And to begin the conversation, I think it's important that we know what we're talking about. So when we at Degrowth Switzerland use the word degrowth, we're referring to a just and participatory process of political, economic, and cultural transformation, which rapidly reduces a society's absolute negative impact on the environment, basically bringing economic activities into planetary boundaries, while enabling a good life for all. This would require reduction of material and energy throughput in high-income countries, which would most likely result in a decline of GDP. Now, in relation to this conversation, we've been using the word post-growth, which is more or less what happens once we get there. It's a steady-state economy which provides a good life for all within planetary boundaries. So with that, I'd like to kick off the conversation. I'm really curious, how did we get here? Louison, you look at these things and think about them on a macroeconomic scale. Could you give us a bit of the context historically in terms of the key developments that led to the financial system as we know it today? How did we get here?
Yes. Hi, everyone. Thank you very much, Anastasia and Degrowth Switzerland for the invitation first. So it's a very long way that led us there, so I won't tell the whole history of it, but maybe it's interesting to start in the modern era in the early 70s, because what happened in 1971 is that there was the beginning of the collapse of the so-called Bretton Woods monetary system. So the Bretton Woods monetary system that was decided upon in 1944 at the end of the war. In particular, featured a very strong financial regulation, capital controls, and it was the central banks who were essentially negotiating the exchange rates with each other. So there was no exchange rate market as we know it today. In 1971, the US decided that the dollar will no longer be convertible into gold, which was one of the main pillars of the system. And in 1973, there is the abandonment of the fixed exchange rate system. And then in 1976, it was the official end of that Bretton Woods system with the Kingston Agreement. And from then onwards, therefore, there was a regulation first of exchange rates. Then there has been the liberalization of interest rates, the liberalization of credit, and that was the start of financial deregulation as we know it today, and that fashioned contemporary capitalism very, very deeply. And from then, therefore, financial risks, as we know them today, started to appear. For instance, if you look at the data of exchange rate, it's very striking. Up until 1973, exchange rates with the dollars, any currency with the dollar is essentially flat. And from then onwards, it starts fluctuating a lot, which creates exchange rate risk. Then with interest rate deregulation, there was the appearance of interest rate risk and so on. And on this, a whole financial industry started to emerge to hedge against those risks, which led in particular to the appearance of so-called derivatives that we all heard of when the subprime crisis in 2008 exploded. And therefore, the financialization system, which is the emergence of both a very strong financial industry and also the emergence of finance as a prominent management principle of non-financial firms. So non-financial firms started to act very much as financial investors, and in particular, they started to prioritize shareholders, so-called shareholders' value maximization over other goals. So essentially distributing dividends or prioritizing short-term financial profitability over longer-term industrial development goals, for instance. All of this shaped very much especially high-income economies, but not only high-income economies, because the financialization system, the financialization process worked hand in hand with the globalization process. Because with the offshoring of a lot of industries to lower-income countries, this process of offshoring freed up a lot of money, a lot of profit that did not really need to be reinvested in those countries because prices were very low, and that were not reinvested in the domestic countries of those firms. So all this money essentially started to be invested into financial accumulation, into financial assets. So you have the both process, financialization and the globalization of production, that from the 70s onwards up until today were like the key driving force underneath like the restructuration of production at the global scale, and that resulted in particular in the emergence of global production chain, global value chain as we know them today, and that were seriously disturbed during the COVID crisis. So this is to give you very quickly in a nutshell like the long process in the past 50 years that led to contemporary capitalism as we know it today.
Yeah, thank you so much. So you mentioned a lot of things, but one of them was this process of, say, moving resources around or extracting value from certain markets and moving it into others. Maybe we can use that as a bridge to the question of the outcomes of this current financial system. It sounds kind of like there's winners and losers. I think we kind of know that if we're using binary language. Maybe Louison, can you start by outlining who you see benefiting from the current system? Who is it serving less well? And what are the unintended consequences of the current setup?
Yeah, well, I mean, the outcomes are very diverse. If you look at it from a high-income country's perspective, a major outcome was the appearance of the reappearance of mass unemployment in those countries, because a lot of industries got offshored, and the profits made out of offshoring were not, as I said, were not reinvested in the domestic countries, which could have triggered some gains from the process, but it did not, you know. And of course, so that led to the rise of inequalities, that also led to downward pressure on wages. You know, the reason why inflation has been very low or almost non-existent in high-income countries for about 40 years, from the early 80s to now, essentially to the COVID inflation, has very little to do with central bank actions and a lot to do with downward pressures on wage and with what some economists have called the great doubling, which is in the space of like 20 years, the doubling of the labor force at the global scale, because in 20 years, you had all the workers from the former Eastern Bloc and also from Asian countries arriving on the global labor market. And that, of course, created a lot of competitions amongst workers worldwide. So in high-income countries, that led to the rise of unemployment and inequality. In lower-income countries, of course, that led to some progress, because there was, of course, some some people who benefited from it, either through employment, the emergence of the so-called global middle class, and so on. And that led to industrialization of some countries, especially Asian countries. But that also led to a lot of inequalities in those countries, because not everyone benefit from those processes, or not in an equitable way. And of course, from an environmental point of view, this is very problematic, because it's it's all about extracting value. You know, financialization is all about extracting value to satisfy pretty high financial profitability expectation, often financial profitability expectation that are kind of disconnected from economic, industrial, and ecological realities. When an economy grow by 2, 3, 4, even 5% a year, and you expect 15% return on investment, that cannot go on forever, except if you regularly lay off people to increase financial profitability, and so on. So that essentially resulted also in a massive transfer of income and wealth from the global working class to capital and asset owners. But of course, there are a lot of ambiguities. For instance, I live in Denmark, where pension funds have a very important place, and I'm sure many people around have stakes in pension funds. And pension funds have been one of the main financial institutions driving this process of financialization. And as soon as we have stakes in pension funds, for instance, we are also part of the problem, even if we don't want to. It's not, we need to think about it in both abstract and concrete ways. In abstract ways to identify key mechanisms, but also in concrete ways to really realize that there is a class of high bourgeoisie, great capitalists benefiting from it. But nowadays, societies are so financialized, also for key things such as pension, that we all are, to some extent, involved in the process, both as workers, but also as so-called investors.
Mm. Yeah, thank you so much. So another of the consequences of this inequality, or the divide between wealth holders, let's say, and the rest of humanity, is related to decision making, what we invest in for the future, right? So pension funds are a big, or other institutional investors are big actors in that space, but so are independent wealth holders, let's say, and venture capitalists. And Melanie, this is kind of your realm of expertise. Can you speak to the current system from your perspective, VCs, entrepreneurship? How does the current situation change how decisions are being made?
Absolutely. So, look, I'll preface this by saying that I'm a serial entrepreneur myself, right? I mean, my day job when I'm not talking about Postgrowth is I'm running a 50-person cybersecurity company. So that's actually what pays my bills most of the time. At the same time, I made something a bit different about the company. First of all, I decided to make it steward owned, which is a colloquial way of saying I gave the company to a foundation. And I also used a odd business model. It's a Dutch fiscal construction called a fiscal fundraising institution, which was an odd offspring of the Dutch church, in which churches sometimes want to make commercial spin-offs of things, and then the money goes back to a church with a tax benefit. But the reason why I use this is because it forced me as an entrepreneur to donate 90% of my profits to charity. 90. The last 10% of my profits are my cash flow buffer that I need to make payroll at the end of every month. And of course, when I first started the company, saying I wanted to make it a quote unquote not-for-profit company, people didn't think it was even possible to start a company in such a fashion. But at the same time, now we're going on our 10th year. We've got roughly 50 people, and we've also donated roughly €750,000 to an internet-related charity called the NLNet Foundation, which redistributes that money to open source digital rights initiatives and everything for a better open internet. Now, going back to this perspective, when I started getting incubated, because I, of course, went to an incubator and I went through a startup boot camp, it all starts with the PowerPoint slide with the exponential curve on it, right? And then they point to it and they say, do this, right? After that, they tell me that my definition of success is the exit. So, and then after that, then they tell me, and by the way, you need an investor. Well, I was interested in starting a not-for-profit social enterprise. I mean, something really for impact rather than, and I looked at this and I was like, this doesn't make sense, right? And mind you, I didn't have a business background, right? I didn't have an MBA. I hadn't studied finance. I was just a techie. I was a former assistant professor of computer science, completely green into this system. After a few years, I sort of went from this doesn't make sense to, well, actually, no, this does make sense, but not for me, because what's actually happening here is that we are essentially treating our startups like, well, basically factory farm chickens. So what we're doing is we are force feeding them investment capital in an attempt to get them plump and juicy and attractive looking, which leads them in a limited period of time, preferably 3 to 5 years, to their liquidation, which is the moment when, of course, the financial value is pulled out of the company, leaving a dysfunctional carcass of a company left over and enriching a small privileged number of people. If you want to build particularly any kind of social enterprise, this does not make sense because, what I really want to build is a company that's oriented towards the long term. Right. And the other thing also is that when we're working with VCs, getting this huge infusion of cash, this is not the way to build financial discipline in a startup, because the moment that you receive this big pile of money, what are you going to do? Well, you're going to spend it. It starts with giving yourself a salary. It continues with hiring other people. And really what's happening here is it's all optics, right? What's actually happening is we're trying to essentially create a pump and dump scheme onto the public markets. So we're taking this inherently cash bleeding thing, because if you're hiring that many people this quickly, then there's no way that you can be in the black, right? And of course, the majority of our aspirant unicorns are in the red, and deeply so. And some of these unicorns never get out of the red, by the way. But what basically is happening is we're hyping this thing and we're pumping it up, right? And then we're dumping it onto the public markets, right? And the reason why people buy it, of course, it was inherently cash bleeding before, for example, an IPO. It's going to continue to be inherently cash bleeding after an IPO, but people are speculating, right? We're all betting on the greater fool theory that it doesn't actually even matter what we're buying, as long as there's a greater fool that will come after us who's willing to pay more, right? And this is the basic principle behind, well, the entire stock market. Of course, the IPO market, cryptocurrency and NFTs, tulips, take your pick, but really, if we're at that point, after you've dumped the shares, you just walk away because you're like, well, you know what? This isn't my problem anymore, and inevitably, this works in a growth economy. But the moment that the economy starts to stagnate or, God forbid, goes into recession, then, of course, the last investors are left holding the bag. The value tumbles. And but at this point, as an early shareholder, well, this is no longer my problem. So, the other thing also is we are learning to become unicorns, right? The holy unicorn. This is the goal. This is success for everyone in the finance industry, particularly for VCs. But we don't ask ourselves often enough, well, what is a unicorn actually? We understand, okay, technically speaking, it's a company with a $1 billion valuation or higher. But what's actually happening here? So what we're doing is we are creating this class of companies that are basically, they're not actually the kinds of companies that they say they are, right? Let me clarify. Like, I'm running a cybersecurity company that was bootstrapped. In other words, what this means is all of the money that my company has to survive on is coming from customers. Not too perplexing. That's actually what a business is, right? Well, not entirely. Of course, nowadays, most of the businesses, they get this faucet of basically of never-ending money by selling stock, right? And in a sense, I mean, it's almost like as companies, we're performing MMT, right? Modern monetary theory. What we're doing is, it's just like our stock is our sovereign currency, and we can basically print as much of it as we want. And as long as there's a social contract that this stock is actually worth something, and of course, coming back to speculation, whether or not it's worth it depends on whether or not people are willing to pay for it. And it turns out that it's far more profitable to sell stock in the majority of cases than it is to actually sell the products and services that our companies specialize in. So what winds up happening is we produce this entire class of companies, which basically they purport to be selling a product or service, but actually the heart of their business model is stock, is equity, and they are not actually in the industry they say they are. They're financial institutions, right? I mean, if you actually look at their factual business model. But this deforms entire markets, and it causes them to evolve incorrectly, because any kind of SME, for example, that is actually relying upon selling to customers, we have to compete with these cash bleeding zombies. Right. And, and basically, if I have a cybersecurity company that lives off of customer revenue, and then let's say there's a competing company that's in the same market that just got a drop of, let's say, 11 million, from various VCs, then, yeah, I mean, if they're bleeding cash this quickly, of course they can afford to pay better than me. Of course they can afford to have services that are far cheaper than the ones that I can provide, right? And at the end of the day, it's, it really, what's happening here also with these unicorns is we like the word unicorn because it looks all like shiny and rainbow colored, but you can take that word and replace it with the words pension fund, subsidized, monopoly forming. Because that's actually what's happening here. And yet, most of us don't see it this way. And in fact, there's entire lobbies that are just shouting, we need more unicorns, in Europe, in the Netherlands, in wherever. I mean, do we? Do we really? And this is the problem. We are not asking these essential questions about, is exponential growth good? Do we really need investors when we're creating our startups? Is the exit actually the appropriate goal that entrepreneurs should be aiming for? And as soon as you start digging a little bit deeply into the underlying questions of why are things structured the way that they're structured, then you start understanding that, wait a minute, but this is the system that is creating all the inequality that is plaguing the world today, that is causing companies to externalize their costs onto society and onto the environment, thus creating the climate crisis that we're facing today. So my thought and my belief really is that it all starts with corporate governance. It starts also with the way that we're teaching our brand new founders how to create their companies and showing them where the goalposts are. And these are precisely the things that we need to question. And for me also, if we want to build an economy that thrives without growth, or God forbid, an economy that thrives while shrinking, which, by the way, this whole degrowth economy thing, I mean, it's not just a hypothetical. I mean, we are in recession a good portion of the time, whether we like it or not. And if we want to be able to create an economy that does thrive in recessionary conditions, then we do need to start thinking about how is it that we can create companies that are not financially extracting, right? Because the financial extraction is the root cause of the necessity for eternal growth. And if you want to build a post-growth economy or a degrowth economy, it begs the question of how do you build a post-growth business and a degrowth business. And this is what I've spent a lot of time myself also with my incubator nonprofit ventures investigating.
Thank you so much, Melanie. Yeah, it's great to have your perspective. I know that, the VC market doesn't necessarily represent all of finance, but I think it definitely gives some insight into how businesses and the financial sector are set up today. On that note, we know that traditional finance as such kind of got us into this situation, but sustainable finance has become increasingly interesting to investors and the broader public. Vibeka, I know you've been focusing on this issue for many years, or topics related to sustainable finance, ESG investing, impact investing, and I was hoping you could give us a bit of context with regard to what do those terms mean? Mm-hmm. What has sustainable finance as such been able to achieve thus far? And what are some of the pitfalls of these approaches in truly addressing sustainability and social justice?
Okay, thanks, Anastasia. So I'm going to start with a caveat that there's not complete industry consensus on the definition of sustainable finance, but there are policy and industry moves happening to try and bring clarity to this, which I'll explain later. So sustainable, or sometimes ESG investing is called, is broadly defined as investment decisions that take into account environmental, social and governance factors of an economic activity or project. And investors use their own research, ESG ratings and data to identify ESG risks and opportunities and use it to guide their investment decisions. There's offshoots of this and different terms that investors use to categorize their investment approaches. So there, for example, there's thematic investing, where you invest in an specific environmental or social topic, such as water funds or climate focused funds. There's terms such as impact investing, where you invest in assets which have a positive or social or environmental impact, and you measure that impact. Some people have tried to classify these different approaches I've mentioned through a spectrum of capital, showing how different investment approaches and their financial goals align to the impact they make both on people and planet. And I'll link to that after the chat. So it takes you from traditional investment to philanthropy, and how the financial goals and positive impact goals, so it differ with the different investment approaches. So what have they been able to achieve? So I say ESG investing, which, as I said before, is using ESG factors to assess risk and opportunities, is quite contentious currently. A lot of people are arguing on the real world impact it actually has. So, for example, Elon Musk has often criticized ESG. He notes that tobacco company Philip Morris often has a higher ESG score than Tesla, for example. And this is because ESG looks at the environmental, social and governance factors of a company's operations. So Philip Morris, for example, could be very energy efficient in its operations, but obviously its products and services don't necessarily have a good impact on society. Related to this, there's arguments of greenwashing in funds labelled as ESG, as they often hold fossil fuel stocks or weapon stocks for the reasons I've said before. So their operations maybe have a good ESG picture, but obviously kind of their end product or service doesn't have a good impact on society, but ESG doesn't often reflect that. But there's government initiatives happening, for example, in the EU and the UK and the US to tackle this through policies such as fund labelling. So if you have ESG or sustainable in your fund name, for example, you have to meet a minimum criteria of what's in your fund, but these are still in development currently. Also, some people argue that ESG investing, and also there's a body called the Principles for Responsible Investment. This is a 15-year-old network of financial institutions promoting ESG and sustainable finance, and they all align around principles defined by the Principles for Responsible Investment. So it's been around for about 15 years. And in that time, inequality has risen, the climate crisis has escalated, and nature loss hasn't abated. But I don't want to be too negative. There are kind of positive things I think that have happened with the ESG movement. It's kind of helped rise kind of environmental, social, and governance issues up the agenda. And the financial sector, I think, has realised it doesn't operate in a silo, and it has to consider these externalities and its effects on investments, and the effects of investments on the environment and on society. There's also been kind of an increase in kind of climate-related issues, data sets, around climate-related issues that investors are starting to use to assess risks and opportunities. Policy work in the area of mandating investment funds to report on climate-related risks and opportunities. And this is now moving to biodiversity and social issues. There's also been movements and coalitions on engagement in companies on ESG issues such as human rights or biodiversity loss or gender or racial equality. And one positive impact I think that can be tracked and measured is, for example, the increase of women on boards in some countries, such as the Nordics, through ESG engagement with companies on the issue. But admittedly, with a lack of measurement, it's hard to confirm the real world impact of ESG. Because it's hard to define, basically, and there's no kind of consistency in the approach from investors. Also, in recent times, it has become quite politicized. So in the US, there was an anti-ESG movement with some US states, often mostly Republican states, actually banning where they can state funds doing ESG or state funds doing business with investment firms doing ESG. This has roots in oil lobbyists and climate denialism, and is also an inversion. There's also an inversion to diversity, equity, inclusion measures from these bodies. And another issue with ESG is that it doesn't address the whole system it's investing in, which, as Melanie has alluded to and others argue, is driving unsustainability. But there are pockets of activity starting to happen in this space. So investors are starting to look at engaging and acting on kind of systemic issues affecting their investment portfolios, such as inequality or climate change or biodiversity loss.
Awesome. Thank you so much. I mean, not awesome situation, but great to hear your perspective on this, Vibeka. So as we heard from you, sustainable finance and ESG measures are kind of trying to price in some of the current externalities that we see in financial markets today. Typically, financial markets are seen as in a different category to the so-called real economy. And yet from an ecological economics perspective, financial stocks or flows are always tied to some material change in our actual physical environment. Nuisson, I was hoping you could elaborate a bit on this and what it means for considering what genuinely sustainable finance, not just ESG or the consideration of certain risk factors, what could genuinely sustainable finance look like?
Yes, that's a key question and a tricky one. And I think Vibeka already pointed out some difficulties when explaining that there is no consensus in the industry, but also in the academic literature, for instance, on what sustainable finance is. And one of the difficulty is to know what is a sustainable asset, because when we invest in something, we invest in an asset, right? It can be a share, it can be a bond, it can be other kind of assets, and this asset, in principle, will eventually finance an economic activity. However, what is a green asset is a tricky discussion, because the same thing can be green or not green, you know, and there are some taxonomies now, so-called green taxonomies. There is the European taxonomies on green activities that is in the making. There is a Chinese one. The Climate Bond Initiative had a third one. And when you look at those taxonomies, they do not overlap. So they have some inconsistencies. So they are not elaborated exactly in the same way. Some activities that are considered green somewhere are not considered green somewhere else, and so on. So there is a consistency issues. Another issue is who gets to decide what is green and what is not. Because this will have very profound implication, because what these taxonomies label as green will receive a lot of money in the years to come, and that means investment that will shape our societies for decades to come. Okay, so that is a huge democratic issue. And for instance, when the European Union, for a number of reasons, decide to include, for instance, nuclear energy and also natural gas as green or so-called transition energies in the taxonomy, that means that a lot of money, for instance, will go into natural gas, which is a carbon-intensive energy, even if slightly less carbon-intensive than oil and coal, and even that could be discussed. All this infrastructure of natural gas won't disappear. And like at the current rate of CO2 emissions, right, we will have exhausted our 1.5 carbon budget by 2030, okay, in 7 years from now. Now, all this infrastructure in natural gas that is being built and will be built in the coming years will come in activity in the following years, and it won't disappear by 2030. People who invested into it, they will want their money back, and they will want to make a profit on it. Okay, so that creates huge carbon lock-in. So those taxonomies are a huge democratic issue, and therefore the notion of green, because it's a concept that we use in every discussion in every possible ways. It's very important to keep in mind that this concept of green, it's not a scientific concept. It's a political concept, which is not necessarily a problem if it's decided upon in tractable, transparent, democratic ways, which is not the case currently. Where it gets tricky is that nothing is absolutely green. For instance, let's take the example of an electric car. If you replace your thermal car, or even better, several thermal cars with one electric car, you could consider it a green investment. Although we know that electric cars also are not environmentally neutral devices, of course, but it's still, you could consider it still greener than a thermal car. Now, if the shift towards electric cars means that billions of cars will need to be built to replace old thermal cars, and that may result on a new era of individual cars, that's not green at all. That's not green at all, because the batteries are extremely environmentally harmful to be built, and more generally, all the materials that we need to build cars, they will need to be mined to a great extent, and that will increase the pressure on the environment, especially the pressure on biodiversity. And guess what? Biodiversity plays a huge role in the regulation of climate. So this points out to some feedback loops that exist within the biosphere and that we need to take into account where we're talking about sustainable or green finance. If we finance, for instance, low carbon infrastructure in the form of energy producing devices or any kind of electric devices, we are also in the same way increasing pressure on other areas of the biosphere like biodiversity, which themselves play an instrumental role in the stabilization and regulation of climate. So we are always talking about net zero objective when it comes to climate, right? But who exactly is supposed to ensure the net part? It is biodiversity, it's the forest, it's the ocean, and so on. So if we put biodiversity under pressure, then we are putting the net part of the net zero objective in danger. Could we really consider, if we take that into account, if we have all those feedback loops and interconnection in mind, could we consider that, for instance, investing into renewable energy is green? To some extent it is, because it's certainly greener than investing in fossil fuel energies. But if we do it to a level that is too high, then it's not green anymore. So there is also the volume effect. That's what I was saying. Nothing is absolutely green. Because there is a limit to what we can produce, even if it's low carbon, even if it's carbon free, and that of course links to the degrowth critique of current economies. One or a few million electric cars to replace much more thermal cars could be green, but billions of electric cars are not, you know? So it's not only about what we finance, it's also more generally how we organize our societies, so that, as you were saying, Anastasia, in introduction, our economic activities, our way of life, do not exceed planetary boundaries. So to try to answer your question, how a sustainable financial system would look like, maybe what I'm going to say would be a bit surprising, but I think like the very basic financial mechanism, like maybe the most basic of all of them, which is money creation as debt bearing interest, that could still remain the same. Because the problem is not so much how money is created. The problem is more who gets to control the financial institution that create money, namely commercial banks, and therefore who decides what gets financed, what kind of activity and at what rate of interest and so on. That also links to what Melanie was saying earlier about the role of venture capital, right? Because banks and venture capital have this in common, although they are different kind of finance, they have this in common that they intervene at the early stage of an economic activity. So they have a lot of power because they get to decide what can be financed or what cannot be financed, and therefore what kind of economic activity can emerge in a society, right? So for instance, if we were to transform banks into a common supervised by citizens, by representatives of civil society, representative of workers, of NGOs, of any kind of organization, who would set the direction of what gets to be financed. That could be an example of a financial system. If people are interested, if I can do a bit of a shameless self-promotion, there was this book published a few months ago called Degrowth and Strategy. It's free. You can buy it if you want, but you can also download the PDF for free legally from the publisher website. The publisher is Mayfly, I think. And each chapter is about a different area. So you have everything from agriculture to housing, food, and also the financial system. With a few colleagues, we co-authored the chapter on financial system, and we discussed this, and we try to sketch what could be a sound financial system. But it's also quite clear, and I will conclude on this, that a lot of financial activities that exist today would simply need to be forbidden if we want to make the financial system useful to society and sustainable. For instance, all the derivative industry that has very little to do with financing the real economy, the productive economy, needs to be forbidden. There are a lot of things that are essentially useless and even detrimental to society in the financial industry as we know it today. But the most fundamental mechanisms, I think, are not problematic in itself. What is more problematic is who controls those institutions, and therefore who gets to decide what is financed and what is not.
Thank you so much, Luis. And yeah, as we start thinking about what this system could look like, I'd be curious to hear from Melanie again. There was a term that you mentioned briefly, but we didn't include in our definitions at the beginning, the term non-extractive finance. So this sounds fundamentally different than the financial structures that Louis Font and others described. Can you describe what you mean by the term non-extractive finance and how you see it working both in your business and in the businesses of those that you support through nonprofit ventures?
Sure. So I think first in talking about non-extraction, I think we need to address extraction, of course. So, and I would like to start just by considering our semantics. So consider the word profit. Everyone thinks that they understand what the word profit means. But do we? So the word profit actually has two meanings embedded into the same word. The first meaning of the word profit is what I would call reinvestable margin. In other words, I sell something to you, I put a margin on top of that, and I reinvest that into my business for the growth and stability of my business. That's the first meaning of the word profit. The second meaning of the word profit is financial extraction. So in other words, this is what pays for my private jet and my Lamborghini and my private island, and obviously this is not only inessential for running a business, but it's actually detrimental, because when cash is pulled out of a business, it means that there's less cash left over for actually behaving like a business. In other words, for being able to pay our staff fairly, for being able to invest in research and development, for doing quality assurance on the products and services that we're selling, on lowering the costs for our customers, et cetera. So, financial extraction is a competitive disadvantage on the market for companies. And yet, because both of these meanings are embedded into that same word, profit, it creates a lot of confusion. People will say, of course, my company needs to be profitable to survive. Again, if you're talking about reinvestable margin, absolutely. If you're talking about financial extraction, well, actually, that harms your company. On the other side, the word not-for-profit is equally problematic, because, when you say not-for-profit, for example, you have things like nonprofits, NGOs, they understand that you're not supposed to have financial extraction, right? But the problem is they think they're also not allowed to have reinvestable margin, which basically puts nonprofits and NGOs into a situation that they fall into something called the subsidy trap, which basically means that they become reliant on donations and on subsidies, which are inherently unreliable sources of funding. And particularly in the political climate that we have at the moment, these sources frequently are drying up. And they might want to move to more sustainable financing sources, such as harnessing the power of business. But the problem is that if they do, the tax authorities can even get on their case, potentially even threatening to revoke their charitable status because they're behaving too much like a business. And this, of course, is an existential crisis for a nonprofit or NGO, because the moment that the charitable status is revoked, then, of course, donations are no longer tax deductible, and you can sort of kiss this nonprofit goodbye. So, further extending this, this problem is when we start considering social enterprise, and in particular, the triple bottom line of people, planet, profit. There's that word again, So if you divide it out, what we actually have is people, planet, reinvestable margin, financial extraction. So the triple bottom line that we really need is people, planet, reinvestable margin. And that financial extraction is the greenwashing. So if you want to remove greenwashing from social enterprise, it is actually really that simple as just get rid of the financial extraction. It's the same thing also with ESG, right? With ESG, okay, we've got environment, social, and governance concerns, right? Now, the E for environment is incredibly popular, right? In part because it's we've got climate anxiety. It's also easy to measure, relatively speaking, also because, things like, carbon emissions, but also the E is very popular because it's really easy to greenwash with, the S as well. Well, we kind of understand that we want to make things better for society. We know that poverty is bad. You can maybe sort of measure a little bit of it, but great, you can give 10% to some charitable organization, but at the end of the day, you can still greenwash with it too. Now, the G for governance is the dust that's swept under the rug. It is the orphan child. See, very few people want to touch the G quite precisely because it's extremely hard to greenwash with. But if you consider it, though, the G, the governance piece, is the root cause. The E and the S are the symptoms. If you can fix the G, the governance, then the E and the S come along for the ride, pretty much for free. There's very few fund managers. And in fact, in ESG, anyhow, there's very few metrics or indicators even that are paying any particular attention to the G. And yet, if you consider things from a systems thinking perspective, the G, of course, these are the these are the incentives that drive the larger organic behavior of the system, right? But the problem is we're playing whack-a-mole with the E and the S, right? In the Netherlands, in Dutch, we have a wonderful expression. In Dutch, it's called dweilen met de kraan open. In English, it translates as mopping with the faucet open. So, basically what we're doing right now is we're mopping the E and the S, right? I've been trying to go after those symptoms when actually the G is the faucet, right? And we can sit there and keep mopping, but actually in reality, what we need to do is we just need to turn off the damn faucet, because the reason why we are unable to take care of the environmental and social problems is because companies and finance are creating these problems faster than we can fix them, right? But then this requires a dramatic realignment of incentives, right? And behind the whole incentive structure, that comes back to financial extraction. If no one is getting unnaturally wealthy from a particular business, then the only purpose for being that is left over is positive impact. That's it, and any company could be a social enterprise by merit of the fact it has a value proposition and it's offering some product or service that someone finds valuable enough that they're willing to pay real money for it. But the only thing that we need to fix is getting rid of that financial extraction, right? And this is actually not as hard to fix as you would think, and it starts with concepts like steward ownership, asset locks, really putting mechanisms in place to ensure that cash is not leaking out of the whole thing. It's the same thing also with the finance industry. If you consider things like venture capitalists, and you wonder also with things like, social enterprise and impact incubators, why is it that we're still creating all these, companies that are, we're selling our B corporations to Unilever, right? We kind of understand that, this isn't necessarily getting us where we need to go. But if you need to dig a little deeper and look at the underlying incentives, and it starts with fees. So if you consider the compensation structure of the typical venture capitalist, they usually use something that's known colloquially as the 220. So in other words, 2% asset under management fee, 20% carried interest. Now, basically what this means is if you are what's called a limited partner, in other words, you are giving your money to this fund manager to invest for you so you can get returns, they get 2% of this. That's the asset under management fee. And the 20% carried interest, what this means is if my portfolio company grows exponentially and exits, I get 20% of that. Now, I would say that's a pretty strong motivator for even an impact VC to push their social enterprise to grow exponentially and to exit. Now, you can also say then that the 20% carried interest embeds the growth imperative into startups. So if you want to create startups that are not being pressured to grow exponentially and exit, or in other words, to ensure that they can structure themselves for the long term, then all we have to do is cut that carried interest out of the compensation structure of VCs. That's it. It really is that simple. But the problem is, if you go to most impact VCs and you say, hey, you're all about the impact, right? Would you be willing to reform your fee structure to remove the carried interest, from your compensation package? Most of them will look at you and they'll be like, yeah, I wasn't talking about that. But this is really where the rubber meets the road about how impact oriented someone is or not. And it turns out that there are fund managers who are doing things differently. I can give you one example. For example, there's a fund that is known as Snowball Impact Management. It's a fund of funds based out of London. And what they've done is, first of all, they house the entire thing underneath a foundation. So basically, it's 100% foundation owned. And secondly, it reformed its fee structure. So the 20% carried interest is gone. On top of that, also the 2%, we don't think about this often enough, but the 2% is also extremely extractive. 2 sounds like a small number, but most people don't understand compounding. Now, just to give you an example, if I want to retire someday, so I put my money into, say, a Roth IRA or a 401k, and there's a 2% fee for my fund manager. Given the historical performance of the stock market over the last 25 years, with a 2% management fee, I am giving literally 2/3 of the returns to the fund manager. Most people don't realize this. So, but John Bogle, the founder and CEO of Vanguard, he used to shout about this all the time. I mean, about the tyranny of the compounding fees and the conflict of interest between the fund managers and the investors. And ultimately, when he said investors, he meant people like, for example, pensioners, people like you and me. So, and this was precisely the reason why he invented the index fund. He was basically trying to create a kind of investment vehicle, which essentially, because it was passively managed, it would just track, a particular stock market index without further thinking about it. He was able to drive the fees basically more or less down to zero, And when he first introduced the index fund, they called it Bogle's folly, because he was essentially trying to create a kind of not-for-profit investment fund. Yeah, Bogle's folly indeed, right? I mean, because of course, nowadays, the index fund, and of course, its superset of ETFs, electronically traded funds, is now 35% of all investment everywhere, and of course, Vanguard now is also one of the big 3 asset managers in the world, one of the 3 largest. So, it turns out actually that the whole concept of not-for-profit finance is not that crazy, and it actually really has quite a storied legacy. But most of us, of course, don't think about it. Another really interesting example also of not-for-profit finance is if you consider the Purpose Foundation in Germany and also Purpose Ventures that they similarly have created, same thing. I mean, they also have been putting it underneath a foundation, and really, they've set things up in a way that they're also trying to get the extraction out of the fund. But the point is that, these fund managers are there. And yet, they need to get traction, and there's not enough awareness right now on the side of the LPs to actually support what they're doing. For LPs, non-extractive finance, I believe, is particularly attractive. For one, because, hey, low fees. Who doesn't like low fees, right? And secondly, also because by eliminating essentially the conflict of interest between the GPs and the LPs, you are basically de-risking the investment. I mean, same thing also with steward ownership for the portfolio companies. If nobody is financially extracting, you're a lot less likely to have scandals, right? And it's far more likely to be financially efficient. Better risk-adjusted returns, right? And yet most LPs also are hesitant, particularly the large institutional ones, because it's new, because it's unconventional, and also because most of the fund managers that are trying this are fairly small. And they, of course, have the chicken egg problem of trying to get enough assets under management to also even be taken seriously by these institutional investors, and also even to not be just completely wiped away by their diversification rules. So the problem is we've got this chicken egg problem, and we need to somehow be able to overcome this, because these kinds of developments are truly innovative and will be great for the finance industry. And yet we have to overcome the hurdle that are currently part of the system so we can get there.
Thanks so much. Yeah, so you mentioned awareness, Melanie, and we're talking about some pretty fundamental changes here. Even though they are practically accessible, we have more options than one might think. but it has to do with a cultural shift as well. And curious, Vibeka, how you see the discourse changing among investors and sustainable finance practitioners. What does that look like from your perspective as a journalist? Do you see the conversation changing in the media with the people you talk with? I'd love to hear some words about that.
Yeah, thanks. I have to admit, I don't see the conversation changing much at all. So when I do speak to people in the finance industry or like fellow journalists about the conversations around degrowth or post-growth, it's seen as very radical, anti-capitalist, basically. And there's a kind of, I think, an aversion even to the word degrowth itself, which I think you alluded to, Anastasia. And there's this kind of, in the mainstream financial press, at least, there's this constant focus on growth and profit. So, for example, this week, you've probably all seen in the mainstream press, there's lots of concern about a fall in China's growth. So growth is so ingrained in how the kind of financial sector press, at least, speak about finance. So it's kind of very, I think, uncomfortable for them to kind of discuss even the idea of going beyond growth or post-growth or what that might look like. But there are kind of signs it's changing a bit. So, for example, there was a Beyond Growth conference held at the European Parliament in Brussels in May, attended by figures like EU President Ursula von der Leyen, and I think also a member of the European Central Bank's board also attended. And I think this was the trigger for some mainstream media to start to broach the subject. So The Economist did an article on it, but the headline was "Meet the Lefty Europeans Who Want to Shrink the Economy." So it wasn't the most positive article, but I suppose it is discussing the subject. The Financial Times also covered the conference too. Its coverage was a lot more balanced, but again, it wasn't particularly positive about the idea or supportive of the idea. I think the Wall Street Journal also has done a few op-eds on the conversation around degrowth and beyond growth. But yeah, as I say, I think it's happening, but it's very conservative, the conversation, and very muted. There's been some editorials in the FT, the Financial Times, which have been quite interesting and maybe touch upon kind of post-growth ideas. So, for example, recently the US FT editor said in a opinion piece that capitalism won't deliver the energy transition fast enough. And he talked about kind of governments having to step in and to help fund the climate transition. But apart from that, I don't see the conversation progressing too much. So if that's too negative.
Yeah, thank you. You mentioned, so here we're talking about, or some of the things that were mentioned in the Financial Times were, for instance, that government might need to step in, policy might need to change. I'd like to ask all of you what you see as some concrete policy options for supporting the kinds of transitions that we've been talking about, away from extractive finance and towards non-extractive finance that helps us create organizations and ultimately societies that can thrive in planetary boundaries. Louison, would you like to kick that off?
Yes, I mean, I think that's super important and interesting what has been explained before by Melanie and Vibeka. And to try to, a few options in a nutshell. I think we need to resume the discussion that started after 2008, but that was a bit left completely unfinished, about definancializing capitalism. Not even talking about going post-capitalism here, but there are several kinds of capitalism, some better than others, I believe, and we could even we could just start by thinking what kind of capitalism would be slightly more sustainable than the one we live in nowadays. And I think definancializing capitalism is a prerequisite. And I am always a bit struck when I hear the whole and also take part in the whole discussion about sustainable finance. We kind of want to tailor finance to meet sustainable goals, or rather sometimes to tailor sustainability issues so that they appeal to financial institutions, which I think is a problem. But we don't think about the role of finance. We don't think about what we should make of finance, and that linked to your earlier question, Anastasia, about what could be a sustainable financial system and how we could definancialize capitalism in the first place, which means essentially to come back to an era of extremely tight financial regulation. And there's nothing exotic here. It's been done before. The financial and monetary history is full of tools that we can use, that we know how to control and how to use. There is nothing crazy. There is no wizardry in this. We know how to do it if we want to do it. It's a matter of political willingness to put that into place, essentially. So that's a key thing, I think, to definancialize capitalism, to put an end to extractive finance as we know it, because we need finance. What is finance? Finance is to provide financing means to activities before those activities can generate a revenue on their own. So it's an anticipation on future revenue, right? So when finance plays its role of actually financing, it can be extremely useful and it can be an extremely powerful tool, and it has been in the past. So we can come back to that. We know how to do it. So that would be that would be a first step. And then there are also many others we can discuss, but I don't want to monopolize the mic on this.
Yeah, thanks so much. So Melanie, how do you see this policy question in terms of fostering post-growth enterprises? What would help you and the organizations you work with move faster or scale in the sense of creating more and more organizations of this kind? Right.
I think it would behoove policymakers and politicians to read the books of Mariana Mazzucato. Of course, for those who don't know her, I mean, she is a University College London economics professor. She's written several wonderful books, including one that's titled The Entrepreneurial State. Her thesis in this book is that the government is the world's largest VC, and we are socializing the costs, but we're privatizing the benefits. Now, we don't oftentimes think so much about the how and the why of how this is happening, but the problem is this creates quite some governance problems that we tend to not think about. I can give you an example. So at the University of Leiden, there were some professors who, of course, were doing government-funded research on vaccines. At a certain point, they wanted to valorize their research. So what do? They go to the technology transfer office at the university. The TTO then basically refers them through to the academic incubator, and the academic incubator then says, hey, great, we know a few VCs we can introduce you to. Now, the problem here is that these VCs are coming in at a relatively late stage of the game, and for a relatively small investment compared with the large fundamental investment that the government made, they are getting a large percentage of both the profit rights as well as the voting rights. This is how it's happening, you know? And then the problem is then along comes, this vaccine company, they get in with a VC, it grows exponentially, and they wind up getting acquired by some American entity. Now, along comes the pandemic, and suddenly the vaccines are a lot more important than they used to be. And yet this company in Leiden is forced by its own new owners to serve the US market before it's allowed to serve the Dutch market. Oops, and the problem here is, we don't understand by creating these companies to be sold and oftentimes being sold to foreign entities, with foreign capital, we are essentially giving up the sovereignty over these companies that we're spending so much time and monetary investment in creating in the first place. I can give you a second example from my own industry, cybersecurity. There's also another player that was building network monitoring boxes, and they were also part of, they were used in the Dutch big business, in the government, in the military, all kinds of places. At a certain point, they got acquired by the British. Then the entire Dutch ecosystem let out a collective, oh shit, our data is now going to the British. Hello, GCHQ. And of course, then they all started jumping ship from this particular company. And then there's another startup that spun off of this original company. They too went to an incubator, got venture capital, grew exponentially. And then 2 years later, I read the press release that congratulations to this other, company. They just got acquired by the Romanians, And you start to ask yourself the question of, will we ever learn? Well, it turns out actually the Dutch government did learn, because what they did moving forward is they started requiring any Dutch cybersecurity companies that were dealing with any kind of critical Dutch infrastructure, they required them to give a golden share to the government. We wouldn't call it maybe this way, but that's actually steward ownership, or at least a part of steward ownership. So, what we need to understand is, if we want to solve the problem that Mariana Mazzucato is posing, then we need to indeed think about, okay, but how can we stop that privatization of the benefits? And how do you do that? Well, by building non-extractive companies. Similarly, also with investment funds, sometimes the government just wants to give a pot of money to somewhere and have a whole bunch of to be defined projects happen. Great. Give it to a non-extractive investment fund, and have that then further do the work of distributing these funds. But then what you do is you're shoring up the incentives and these governance structures, thus ensuring that you're not going to have cash leaking out of these government projects left and right, thus enriching a privileged class and leading to government scandals, which may find their way into the newspapers, which ultimately isn't good for anyone. So these policymakers need to understand that non-extractive business and non-extractive finance is good for the government. It's good for the taxpayers. It's good for everyone, and yet, we need to break through these echo chambers, in the government, in the ministries of finance, in the ministries of economic affairs, and they need to not be so scared about things that are unconventional. And you don't have to call it post-growth or degrowth. I get it. It's hard to imagine a world without growth, but at least talk about non-extraction, because I think anyway that's putting the finger on the sore place. It's also a term that's fairly new, so it hasn't been either politicized yet, and it's also a green field, so people are just mostly curious. And even coming back to it, I think it's the kind of concept that potentially can unite political parties, because the whole concept of usury, basically using money to breed more money, is a biblical concept. You can go to the Christian parties and remind them, for example, of the parable of Jesus throwing the moneylenders out of the temple district, right? And similarly, in Judaism, usury is also forbidden. In Islam, I'm sure you've heard of Islamic banking, right? Again, this usury is forbidden. So, and similarly also with dealing with some of the more conservative business parties, they also want the markets to be well functioning. So I think that half the battle is first spreading this information, and secondly, being able to translate it into the language of the different political parties and getting them to understand how this fits into their narrative as well. Because look, the left-wing parties, they already agree with us, so we don't need to spend too much time on them. But we do need to build coalitions with those who don't a priori agree with us. And I believe that is the challenge, and certainly I believe that journalists also like Vibeka, they can play a role. Also, people like me, I started the post-growth entrepreneurship class in the business school at the University of Amsterdam, teaching post-growth entrepreneurship to 120 third-year bachelor students. So we need to communicate this. We need to work it into our education, into our business schools, into our incubators, and as we start growing mindshare, this is when things organically will change.
Yeah, thank you. Vibeka, how do you see this? What kind of policies could help support these transitions from your perspective?
I think something that we haven't maybe touched upon in this conversation is that the financial sector or the companies they invest in don't actually pay for the societal or environmental costs that they impose to achieve their growth or profits. And governments aren't really doing their job in regulating that either. So I think there was an article from a publication called Grist, which I was reading yesterday, which says it turns out that none of the world's top industries would be profitable if they paid for the natural capital they use. And it found they burn through about 7.3 trillion worth of free natural capital a year. And it's the only reason that they turn a profit. And there are kind of moves in the current system to kind of try and account for the environmental and social costs that companies incur. So, for example, this month was the launch of the first standards from the International Sustainability Standards Board to help investors understand the sustainability impacts of the companies they invest in, and hopefully you hope move money to more sustainable companies once they understand their sustainability impacts. There's other groups working on this as well. So in Europe, they're actually mandating companies to report on their sustainability through the European Sustainability Reporting Standards. There's the Global Reporting Initiative, which also has global sustainability standards. And also there's something called the Impact Weighted Accounts Initiative, which is trying to put the cost on a company's environmental and social impact. I'd say that there are still conversations and debates happening on the effectiveness of these new accounting systems and how effective they are of a company's true sustainability, but I think it's a start.
Thanks. So soon we're going to open up for a few audience questions. If you have some, please feel welcome to add them in the chat. First, though, I'd like to ask about the topic of divestment. So lots of people in civil society, activist circles, coming from different places have heard about divestment. It's definitely helped draw some attention to the fact that many of us are, say, invested in fossil fuel companies just by nature of who we bank with. But it's a little bit difficult to know how the mechanisms of sustainable finance actually have impact. So when we divest from a company, we also lose some of our stake in it, our share in it. Melanie, I thought maybe you could contribute to just answering this question. Is divestment a good policy, or is it more complicated than that?
So, when you're divesting from a company, you're selling something on the market. And by merit of the fact that you're selling, it means that there needs to be a buyer. I mean, of course, the theory of divestment is that we're increasing the cost of capital for the company. But of course, in practice, what we're actually doing is we are taking the proxy votes that we would be able to exercise at the annual general meeting of a particular company, and we are giving it to someone else. So in other words, from my moral high ground, am selling my stock in, for example, an oil and gas company, and I am giving it to someone who has no qualms about profiting from such a company. Of course, now this person who purchased these shares gets to vote. So basically, by saying that I'm going to change the world by divesting is sort of like saying, well, I'm going to change the world by not voting in the next election. It doesn't make any sense. What we need to think about instead is engagement. And the thing is, first of all, we have to consider some of the idiosyncrasies of the system. The majority of the money in the financial system ultimately belongs to people. to you and me, right? It could be through our pensions, with us as the pensioners, it's our money. It could be in banks, it's our deposits, it's our money. It could be insurance policies. It's our premiums, it's our money. And yet we are disenfranchised in the sense that despite the fact that it is our money, we are not allowed to vote in the corporate governance process. And instead, these fund managers or sometimes asset owners are voting on our behalf. Now, things are changing a bit with this. In the United States, for example, the Index Act was recently passed by the Republicans, in part as a reaction against Engine Number One and their successful proxy battle against ExxonMobil. But the point is that what this is doing is it is actually passing through the right to vote to the ultimate beneficiaries. In other words, for example, the pensioners, aka us. The reason, of course, why Republicans passed this is quite frankly because they consider right now most of the fund managers too woke, and they wanted, particularly in red states, to be able to enable people to be able to override this so they can vote their values. But look, I have nothing against voting our values. That's democracy, And what excites me then about things like proxy pass-through is that we actually it's corporate democracy, which are two words that you don't normally see conjoined, right? So I'm really excited by the up and coming generation of things like proxy tech that are happening. Different platforms like Tumelo, for example. You also have Broadridge Proxy Edge, which I think is making use of this. You've also got the Iconic app that also, and what they're doing is they're trying to get the actual preferences of these ultimate beneficiaries, oftentimes even retail investors, not just through the institutional investors, thus ensuring that we too can have our say, in voting our values with our money. And to me, this is the kind of thing that creates earthquakes. So, and also I think with those NGOs, and the ones who are going to the pension funds and saying, well, no, we need you to divest. We need to re-educate these nonprofits and NGOs and tell them how the financial system works. Divestment might have worked once, in apartheid South Africa, but it's not working nowadays. And we need to get them to understand that, no, you need to change tactics because if Extinction Rebellion is sitting in the pension fund lobby and they choose to divest from gas and oil, it's counterproductive. We need to get the pension fund to engage because that is what is going to move the needle.
Thank you. So we have our first question from the chat, from Bryony. It's also for you, Melanie. So in thinking about these big transitions, also in terms of ownership structure, Bryony asks, is it possible for large companies such as Apple, Microsoft, or Alphabet to move away from their current shareholder-driven business models? Does change need to come from investors or fund managers, or should it come from within companies? And what about companies that are owned by private equity? Are there ways that they can move more in the direction of steward ownership models as well?
Good question. Look, obviously, if there's a smaller number of shareholders and they're ideologically aligned, it's the most easy to transform a business. Look at Patagonia. Yvon Chouinard, he decided to give his company away to, create the Holdfast Foundation, donate basically all the money to climate activism. Great. But of course, he and his family had control over the company to begin with, so maybe that wasn't that hard for him to do. For a privately held company with more stakeholders, or I should say shareholders, or otherwise with anything that's publicly listed, it's much more complex, but it's not impossible. So I think an instructive example in this case is Elon Musk. Love it or hate it, he managed to completely transform Twitter. And he really showed how if you have a sufficient amount of capital, a knowledge of the financial system and the network, you can completely realign a company politically to fit your personal views. Right. And he was largely successful in doing this with Twitter via a leveraged buyout. So in other words, he first, found the partners. And of course, with leveraged buyouts, you're saddling the company mostly with a debt that fuels the acquisition, which of course, it needs to pay off now through margin off of its sales. Whether or not Elon Musk is going to get unscathed out of this in the end, I don't know. I mean, I don't have a crystal ball, but it does show how you can leverage finance to completely transform companies. Similarly, if you wanted to, with a hypothetical example, if you wanted to transition a company maybe a bit more towards the left, let's say hypothetically you had someone like Bill Gates, right? I mean, similar billionaire, similar knowledge of the financial industry and a similar network. Now, Bill cares about public health. It's obvious, right? With his foundation. But, what if, hypothetically speaking, Bill decided to perform a leveraged buyout on a big pharma company, like let's say Pfizer or Merck or Sanofi, right? Pick one. So the point is that once he performs this LBO, he then installs himself as the new CEO. And then he says, great, from this point forward, my first act as CEO is to take the entire patent portfolio of this big pharma company and release it into the public domain. Poof. Gone. And then my second act as CEO is that I'm going to pivot the business model of this company into generics. And I hope that out of gratitude and reciprocity, you're all going to buy those generics now from me. Wow. Right? I mean, think of how many lives could be saved in this kind of a way. It just requires the will of someone with this amount of capital and this amount of knowledge and the network to even want to do this. And assuming then that Bill could get financially unscathed out of this whole transaction, who could he do it with next? I mean, maybe Monsanto or maybe the gas or oil company? And the thing is, I think those truly that are in finance, let's stop it, too much with, just ending at ESG. I mean, I think we really need to hit hard and go for the really big transformative stuff, but this requires courage, and this requires conviction. Elon has that conviction for his own political views. Now, I want to see someone from the progressive left stand up who has that same courage and who has that same conviction. Because right now, we're too busy doing well by doing good with our greenwashed ESG, and we know that we can do better. And people mean well. No one's bad. Even with a lot of sustainable fund managers, there's things that we're not speaking about. And there is an unspoken tension because we know we are selling greenwashed products, whether it's carbon credits, whether it's blue bonds, whether it's blended finance. I mean, 10% premiums. Come on, guys. I mean, who are we kidding? The point is that we need to, if we want to have any believability left over, and this lack of believability, by the way, is precisely what's fueling that ESG culture war in the finance industry right now in the United States. Elon Musk shouts ESG is bullshit. I'm sorry, he has all this traction because we know to a certain extent that he's right. And it's up to those of us who are on the progressive left to stop building greenwashed ESG, and sustainable products. We can do better. And furthermore, if we want to save, the world literally with the climate crisis, and to improve social conditions, we have no choice. So we need to start, understanding that the responsibility lays with us, and not just with the fund managers, but with the limited partners who are making the allocation decisions, even with the regulators, who are choosing how, the laws are going to be interpreted and choosing what to push back on. We all share that responsibility. But we first need to educate ourselves to understand what the possibilities are, and then we need the courage to do it.
So thinking about shared responsibility, we'll take one last question from the chat. It comes from Hannah, and any of the speakers are welcome to jump in on this one. Just give me a sign. So which political alliances between parties, policymakers, civil society, maybe between sectors of society, do you think should exist or we should promote in order to further the ideas of post-growth finance? Are there any developments that you look forward to in the next 6 months to 2 years, say? Anyone want to jump in first?
I will. Yeah, I'd say looking at kind of communication, which Melanie mentioned, and the kind of necessity of kind of having conversations and press about this. I will say, I think the Beyond Growth conference, which I mentioned earlier, held at the European Parliament in May, was really the trigger for organisations like the Financial Times and the Economists feeling that they had to kind of give this some coverage. So I think it's just, you know, even what we're doing now, I think is going to help kind of, we just keep on talking about it and keep on having meetings, conferences, and get the ideas out there.
Louison, Melanie, either of you want to add some notes to that before we wrap up?
Yeah, I can add something. I mean, I don't want to be the party pooper, but I mean, I was at the Beyond Growth conference. I was a speaker there, and it was a great conference. I agree. It was probably it will probably prove a landmark moment. But it was also instructive because it shown what is the current frontier in this kind of institution. So it was at the European Parliament. Ursula von der Leyen and also Roberta Metsola, who is the president of the European Parliament, came to give introductory speech. Of course, they were not going to embrace degrowth. They are like right-wing mainstream politicians, but the fact that they were there is already interesting in itself. And I heard, like as how to say it in English, off information that the reason why Ursula von der Leyen did not stay after to take part in the debate is because she would have been led to say things that she thinks, but that would have been unacceptable for her own political camp. So it's interesting that because it shows still that we cannot, or these institutions are not yet ready, except for a few individuals, like, for instance, Philippe Lambert, who was parliamentary members behind this conference. Except for a few individuals, those institutions, as institutions, are not yet going beyond the green growth paradigm, whatever that means, you know. And I think when it comes to so political alliances, we can find many allies. I agree with this. However, we need to keep in mind that the extent of the needed transformation will hurt many interests. And I have to say, I mean, I agree with the whole we need to educate, we need to make people aware and so on. But I think it would be still a bit naive that to believe that this would spur organic change. It will maybe to some extent, but some people have no interest in this transformation going on. And if we look back at the last 200 years of social history, if there is something we can learn is that major social progress was never achieved very peacefully. It always demanded strong social movements, long struggles, people willing to take on a big, strong, and hard power struggle, you know, and this was never granted peacefully or willingly by capital owners or power owners, you know. And I think what Melanie said earlier about we need some people willing to have the courage to take on this kind of transformation is interesting, because for me that shows the extent of the problem. If we rely on a left-wing Bill Gates for things to happen, we are doomed. What we need to get rid of is the concentration of power and capital so that citizens can have a voice. And I will finish on that. There are very interesting political experiences in France, Ireland, and Denmark, maybe in other countries, with so-called climate assemblies, climate citizen assemblies. Those are official assemblies made of people who are randomly chosen, lay people, and they are asked for a few months to deliberate on what should be done, for instance, for the low carbon transition. And I know a bit about the French process, and we're really talking about, so it was made about I think 150 people, lay people, some of them 6 months before had barely heard of climate change. They knew nothing about it. But this assembly was given means. They could meet for weekends over 6 months, discuss with experts, interview experts, deliberate among themselves, and eventually the end of the process resulted in a demand of 120 proposed measures. And when you look at the measures, it's extremely radical, and that would definitely put France on the path of the 1.5-degree transition. Of course, when Macron, who instituted the assembly, saw the list of demands, he said, yeah, okay, we are not going to do that. But I mean, the political experience in itself is very interesting. And if anything, it shows that I think what we lack is more democracy, because the moment lay people, ordinary citizens, are given a stronger voice, will go much faster and much deeper. If we wait for left-wing Bill Gates to take things over, we will wait forever. And I don't even think that's desirable, because what is the legitimacy of that person to decide what is good or what is not, you know? I would look for hope in the direction of new democratic exercise that start to take shape. Look at the climate and biodiversity citizen assemblies in France, Ireland, and Denmark. This is very promising, I think.
Thanks. So on the topic of progressive investors, or potentially like more progressive left-wing Bill Gates, I think there's some really interesting things happening, or initiatives emerging at the fringes of the private wealth and impact investing spaces, where people are actually starting to think about redistribution, not only of money, but also of power in really interesting ways. And I hope to get into that in a future edition of this potential series exploring post-growth finance. On that note, I would like to give some insights into next steps. So we at Degrowth Switzerland are going to be at the International Degrowth Conference in Zagreb this year. That's happening at the end of August, beginning of September. Would be happy to see any of you there. Likewise, there's going to be an initiative called Fintopia happening here locally in Switzerland this fall in November, and you can save the date. We plan to have some kind of exploring post-growth finance event at the exhibition at that time. There's also Melanie, maybe you want to jump in quickly and do a pitch for the Postgrowth Entrepreneurship Demo Day. I believe that's happening next week.
So basically about, so look, I'm not expecting that we all need, that Bill Gates is our savior. I was just giving one example, but actually we all can and absolutely can do this collectively. And it starts with things like our incubators. So I'm running a post-growth entrepreneurship incubator via Nonprofit Ventures, and we're having our demo day next week, Friday, basically from 3 until 5 p.m. Central European Standard Time. And if you want to actually see a full cohort of roughly a dozen founders building non-extractive companies to implement this post-growth economy, then I would very much welcome you to join us so you can see post-growth and degrowth in practice in real entrepreneurship. And I'm dropping the link into the chat. feel free to come and check it out. Hopefully you'll find it to be inspiring.
Awesome. Thank you so much. And it is online, so accessible to people that were also able to join today, or if you are tuning in to the recording, you might still have time. And likewise, for those of you based in Switzerland, we'll be having informal drinks tomorrow. There's details for that. You should have received them if you signed up for this event, so you can be in touch. You can also reach out to Degrowth Switzerland if you didn't get those details or would like to join tomorrow. And on that note, I think we can wrap up. So thanks so much to Melanie, Vibeka, and Louison for joining us today. I have so much to think about, and I'm really grateful that we could start this conversation and look forward to seeing how it will go in the future. Thanks so much.